course, we always like to start off the show with a commentary about what happened in the market this week. And so we have this chart here of the S&P 500 going back to the very top, which was the beginning of 2022. We can see, kind of the blue downtrend line there that we broke through this year. And we're just continuing on, actually. We've had some slowdowns here and some pullbacks and what have you. But if you look at the overall chart, we hit that low back on October 13th. Still doing pretty well.
Yeah, and this week's kind of like a low volume week with a lot of people on vacation.
Yeah, and not a lot happening. It's only a 4-day week, as far as the market goes. Obviously, and a half, actually, I guess it's a 3.5-day week because it was a half day on Monday. But there are a few things that have happened that have been significant. There's, number one, the minutes for the Fed meeting came out. And really what was surprising about the minutes was that the decision to pause rate increases in June, which is the first time they've paused rate increases in 15 months, was a unanimous vote. So that's what you heard about. But when you see the minutes, you realized it was more of a 50-50 argument as to whether they should raise rates or pause. And so there was some, I guess some consternation. The main concern, and just keep in mind, the Federal Reserve's job is a dual mandate. It is to keep what they call full employment. Mm-hmm. That's definition is very squishy, to say the least. But nonetheless, also to have a 2% inflation rate. Now, they're looking at core PCE inflation, mm-hmm. personal consumption expenditure inflation, which we've talked about several times on the show. But nonetheless, the factor that we watch for is what they're doing with the interest rates. And so in the past, one of the problems with the Fed is that they've raised rates too far, and it's brought up something broke. Lehman Brothers failed in 2008 happened. We brought down the market in 2000 from the irrational exuberance of the dot-com with 19 rate increases and all these types of things, right? And so that's what the market's looking at now. So when they see the minutes saying, hey, these people are still thinking about raising rates, at least, close to half of them, when a pause was really what was expected. So that was interesting. But then on top of that, we got the ADP private jobs report, mm-hmm. right? And so ADP is a big payroll system, and it's kind of a neat report because basically they look within their system and say, well, how many new people are on the payroll system in total? So not just like new companies they signed up, but existing companies, how many new employees did they add? 497,000 new jobs created in that system in June.
Yeah, and this is it shook the market, you could say.
Yeah, exactly. The market fell yesterday and what have you. And I said in yesterday's video that I don't see that as a bad thing. Every time it happens, and it was actually a big jump over expectations. Expectations were half of that, so doubled expect. That's a big deal. But every time that happens, the market drops. And it's because the market is looking at it and say, oh, that's going to give the Fed more reason to raise rates. If they keep going with rates, they eventually could go too far, slow things down too much, we get the hard fall, right? At the same time, one of the reasons they're raising rates is because we have inflation. And one of the areas that we have probably the most inflation really is the service sector.
Yep.
Now, the service sector uses labor, right? 4 out of 5 Americans that are working are in the service industry, right? And so what happens then is if you're not able to hire new people, it's a great example. I have a restaurant. There's a line around the corner. I can't get enough cooks and waitresses and waiters and busboys and those type of things. So maybe I can increase my prices, to kind of keep the line down. I can make more profits during that period of time versus I'm able to fully, staff my restaurant, and now my line is, shorter. I can't really increase the prices, right? So if you can't hire people, so new hires are super important to bring down inflation in the service industry. And so seeing, job growth like that, I think is important. Now, this does rely upon the Federal Reserve, being at a place where they don't have to raise rates so far that they do end up breaking something, or we end up with this hard landing. So that part of the story is still to be told. So today was another jobs report from the Department of Labor. And so this jobs report showed 209,000 new jobs created. And they're looking at different companies and what have you. We won't get into the weeds of that too much, but what happens there is that was less than expectations.
Yeah, I think the expectation was about 244,000.
Yeah, and so that's actually kind of surprising because usually when the ADP report comes out and it's high, the Department of Labor report comes out and it's also high. And that was the expectation this morning. The futures market was down, overnight, probably because of that expectation. It actually came out low, which is, I don't know if it's come out lower than expectations this year.
It's 15 months in a row that's come out above expectations.
Yeah, isn't that funny? So this is one of my themes right now. Expectations are too low, right? I mean, think about it. You look at the first quarter earnings. Well, I think almost 80% of companies beat expectations. You look at what happened with yesterday's job report, and so Wall Street, the analysts, the different economists that are out there are all expecting less than we're actually getting. Now look at this is why I always watch the price in the market and why this chart's so important. The S&P 500 during that entire time frame of pessimism that's been going on since October 13th of low has continued to grow. So the S&P 500 has been right, even though all of those other analysts and what have you have been wrong, right? It is better at projecting what's going to happen. One of the reasons that the S&P 500 is in the leading economic index, the LEI, which only has 10 indicators in it to make that basket, one of them is the S&P 500, because it does have some good predictive power. So here it is. It's still hanging in there. Still have all of these people talking about how things are going to fall apart, and they might be right. So just maybe the timing's off. Maybe it's later this year, maybe it's next year, whatever happens. Yeah?
Yeah, and a lot of people like this 209,000 job report because it's kind of that sweet spot. You want to be growing your labor force, but don't want to be going at 300, 400,000. And it's kind of nice. A lot of economists say this is where they kind of want the economy to be, and that allows the Fed to have a soft landing.
Yeah, and you were mentioning that the one big negative in that report was the wage growth.
Yeah,
right?
It was 4.4 instead of the 4.2 that was expected.
Yeah, and so that what they're talking about is that year over year, so this June versus last June, wages are 4.4% higher than expected, and expected was 4.2, but nonetheless, that's a big issue too because obviously it's one of the things that drives inflation is the wage growth. We have to keep in mind, though, all the time, and it's hard to do because it's a huge issue, is that wages, labor markets, all those are lagging indicators. The S&P 500 is a leading indicator. And so if you base your investment decisions on what's happening in the labor market, you're probably going to have some problems. Because I remember even my grandmother asking me one time, why is the market going up so much when there's so many layoffs happening and unemployment's growing? It's because the market's looking at that next cycle, right? And the next cycle, when everything's happening in the labor market on the downside, is usually an upside. The reason the lag's there is pretty obvious. It takes time. If I want to do a layoff, you can't just do it tomorrow, theoretically. It takes steps to go through to figure out who to lay off and what package you might have. If I'm going to hire, it's the same thing. Who am I hiring? What's the job recs? Get it out there, those types of things. So there's always this lag in the labor market. And that's why even the wage growth issue can be, a little bit misleading in terms of as an investor. As an employee, that's different, right? I'm looking for a job, or my son or daughter's looking for a job. Okay, that's an important statistic. But in terms of looking at what might be happening to the stock market in the future, be careful about putting too much weight on what's happening in the market. And the reason the market looks at jobs right now more than normal it's just because how it relates to the Fed. You do want to look at what the Fed's going to do. They are a very powerful force in this, stock market growth or lack thereof. I mean, that blue line connecting all those high points in 2022, and the reason it was coming down has a lot to do with the fact that the Fed raised rates nearly 5% last year, which is a big jump, and on a nearly historical basis. So altogether, things are still hanging in there. You can tell this market still wants to go up. We are in a bull market. We have a 20% gain from the bottom. In order to break that we'd have to break a new record. okay, in order to fall back down and fall 20% and get back into a bear market, we've only, we're 8.5 months into this. The shortest bull market is 2 years. Anything can happen, right? But I think that there's this positive that's happening. And one of the reasons that people are missing what's happening so far is the positives are bigger than people think. This pent-up demand and this motion to get out there and do things is really kind of offsetting some of these other areas, right? And so I don't see that stopping right away. I see some kind of, weak areas happening. There's probably a recession already happening in the goods market, the factories, even the retailers are starting to see some pullback. Because those are people buying goods, right? Services or restaurants and hotels and airlines and those types of things. So, and that's what's happening. Now, I do want to spend a little bit of time talking about something we don't talk about very often, which we probably should talk about more. That's just the bond market, because right now a little bit over 60% of our assets within the practice are in stocks, but the rest are in bonds and money markets and things like that. And so it is an important component. It depends on which portfolio you have. So if you have a 20% stock portfolio, the bond market's actually more important to you than the stock market. And so this is going back to essentially the same timeline, beginning of 2022. Big drop. Happens to bottom out at almost the same time as the stock market. So if you look at that bottom, that was October 20th. Stock market bottomed out October 13th. So similar pattern, but again, if we go back to S&P 500, that's where it breaks down. You see it kind of was wandering around, and then it took off. And if you look here, didn't take off. It's still kind of going sideways all year. Now, this is just the price movement, and this is one, ETF. It happens to be a big one. This is the Vanguard Total Bond Market ETF, BND. I use this as a proxy to look at the bond market. It doesn't include everything. It doesn't have high yield bonds. It doesn't have ultra short term bonds. But I think there's 7,000 holdings, 4,000, one of those two holdings. I know it's a big difference, but it's a pretty good representation. And so here's the things that are important to understand about the bond market. Number one is last year was a disaster for the bond market. The bond market reacts to interest rate changes. When the Federal Reserve raises rates as much as they did last year, the price of bonds are going to adjust downward. And the whole banking problem that we had was at least partly attributable to the bond market decline. Because if I buy a bond at $1,000, what they call par value, and I'm a bank, right, and it falls to $700 because they raise rates, banks are required to mark to market now, which means they now have to count, didn't used to have to do this, but they now have to count that as $700. And not 1,000. Used to be able to keep it at par value. Well, that means that their capital requirements, they're keeping this for capital, right? Their requirements are now not sufficient. They got to go out and get money. Silicon Valley Bank went out to try to raise in a secondary stock offering money, and that created the whole cascade for them because people were wondering, well, why do they need money? Well, this is why. I remember seeing an article last year that said that the 10-year Treasury, which at that time was down to about 24%, was the worst downturn for the 10-year U.S. Treasury since 1783. Right? That's pretty dramatic, right? And so this is an important component. The bond market is significantly bigger than the stock market. I remember an analogy once that said if the stock market is a baseball in relative size, the bond market is a basketball, right? Just to kind of give you an idea of the difference. And so the bond market is not super excited about what's happening here because inflation is still kind of hanging in there. The Federal Reserve is still talking tough. They're still talking about 2 rate increases. We look today, the market is priced in nearly, 92% likelihood of an increase in the next meeting, which is here in the 3rd week of July. And no other increase for the rest of the year is priced in for the market, but the Fed says they're looking at 2 increases. And so the bond market's going to have a hard time taking off in this environment where the Fed is continuing to at least talk about raising rates, right? Bond market, ironically, at least in a price standpoint, does better if there's a recession because they'll probably be lowering rates and then the bond values go up. And if you look back at what happened in 2020 when things were falling apart and the bonds were doing quite well, because they were lowering rates down to zero, and so that was a play. As a matter of fact, we were investing in long-term treasuries in April of 2020 and did okay with that because it was a fairly obvious play that was happening. So I think the bond market's going to continue to kind of waffle a bit here for a while until we see what's happening. I also feel, and I've said this last show, I'll say it again, the big talk has been about the recession that's coming. I think that the talk we'll be having more of will be about the inflation that's still here.
Yeah, I think the Fed says if there is a recession, it'd start in October and last till March.
Yeah, exactly, and that's still possible. How does that really impact you? It has to do with how severe the recession is. Is it a slight recession? Is it sometimes that recession you can't even tell? Sometimes you really can tell, like 2008. How does that impact the stock market? How does that impact earnings? So there's a lot of things that we still have to see and how that's going to play out. And again, if we look at what's happening at the S&P 500, it's quite optimistic about how things are going to work out here, at least at this point. So anyway, that's kind of the summary for what we saw happening this week. Stock market continues to do well. Bond market's kind of going sideways. I don't know that the bond market's going to have huge runs here until the Fed settles down, kind of gets things going. Inflation will be the bigger conversation. I get a feeling that we're going to get some report here coming up in the next 3-4 months that where inflation has actually gone up a little bit more, and that's not really expected per se either. So I could be wrong, but I just looking at kind of the feeling for what's going on out there, I think that that's possible. So we'll see. Nonetheless. That's what's going on. I appreciate you joining us for our summary here. I look forward to...
Do you want to quickly go over the signals?
Oh, yeah. Let's talk about signals. I forgot about those. So for the signals for the stock market, we're still green on both signals. And so that's pretty obvious by the chart. You can see why. So even for the fast, shorter term things that we do for the IRAs and those types of things, we're green, and we've been green since, I think, May 10th or something. And the slower things that we use for the taxable accounts where we don't want to make as many transactions is still green. But the bond signals have changed, and that's pretty important to understand. Because of all of this, high job growth, the Federal Reserve's conversations, raising rates twice, Fed governors coming out, talking negative, we've actually gone to double red on the bond signals. And so, for double red, that just means that we're going to a point where we're getting very defensive. T-bills, inverse positions that go the opposite direction of the bond market, for example, just to kind of protect that portion of the asset until things play out. Again, to me, that means, again, there's more likelihood that we'll be talking about inflation not coming down as fast or being sticky or even going up. And I think the bond market is sensing that also, and that's kind of what we're seeing here.
Yep.
Yeah. Thank you for reminding me. All right, thank you very much. Well, again, we'll talk to you again, another summary in a couple weeks.